Hey there, everybody, and welcome to Yahoo Finance Live. I'm Dave Briggs, along with Inez Ferre. Happy Monday to you all. Let's get you up to speed on the market action as we begin this week. Investors on edge as earnings season heats up. We got some numbers from State Street, M&T, and Charles Schwab, and you can see the Dow has now moved into the positive. The S&P and the NASDAQ both sliding towards level territory, and the S&P still hanging on to that key 4,100 level. We'll dive into the stories driving the numbers ahead.
And shares of Google parent Alphabet under pressure. The company reportedly at risk of losing its spot as a default search engine on Samsung phones. The business and legal implications later this hour.
Plus, Netflix set to report earnings this week. We have analyst expectations and a look at whether it's a stock to buy ahead of the results.
And first quarter earnings season rolls on. It's a mixed picture from financials today between M&T Bank, State Street, and Charles Schwab. Banking giants in the U.S., including J.P. Morgan, Wells Fargo, and Citigroup, all reporting better than expected profits in the first quarter, despite the banking turmoil seen in March. But the question lingering is that banking crisis over? Here to discuss is Hugh Roberts, Quant Insight Head of Analytics. Hugh, thanks so much for joining us. So is the banking crisis over?
I hope so. It does feel like it's largely contained. And although they have their detractors, I think you have to give credit to the Fed and other authorities for the speed at which they moved. I think maybe the debate now has probably moved on to the extent that we're seeing the big bank, kind of small regional bank divide open up. And that's what this week's earnings will be so critical on. And I think in particular, what we need to be watching is really the kind of forward guidance from the small and regional banks to give us any clues about whether they are tightening credit conditions and lending standards. And that will feed into the debate about how severe any potential credit crunch might be.
Good to see you. So last week we got J.P. Morgan, Wells Fargo, we got Citi today, State Street, M&T, and Schwab. Is there one trend that you've been watching, one lesson that we've learned thus far?
Yeah, so if you remember, we come exclusively from a macro perspective. So we're very different to your traditional kind of bottom-up company fundamental view. We look at everything from a macro top-down perspective, and we're 100% quantitative. It's all about a smart AI machine. So the takeaways for us so far was that the big banks, most of the big banks, screen as cheap to macro. So although everyone's got excited about the details of the JP Morgan numbers on Friday, our model actually showed that JP went into those results 9.5% cheap to the macro environment. So for us, Friday's price action was really just about catch up to macro conditions. To the question you posed at the start, does that mean that the JP Morgan numbers are a template for the broader sector? Sadly, it's not as clean cut as that. So if we look at the big banks, something like Bank of America is not in a macro regime, so that's much more about the idiosyncratic news. But something like Morgan Stanley is very much a macro play and has the same profile as JP. Macro conditions are improving. The sell-off in March has taken it to cheap levels. So something like Morgan Stanley would be our preferred catch-up trade right here, right now.
Hugh, the NASDAQ is up about 15% year to date. We've seen communication services, technology stocks rallying in the first quarter. Of course, financials, because of the financial turmoil as well, under pressure for the first quarter. So can the banks really continue to lag if we continue to see an equity rally?
Yeah, I think that's, in a way, that's almost the most important question for equity investors at the moment, because it does feel like the elastic on a lot of those kind of relative value plays is becoming very stretched, whether you're looking at growth versus value, or NASDAQ versus S&P, or NASDAQ versus small caps, or at the sector level, XLF versus XLK. All this stuff suggests that, yeah, you can make a very strong narrative about how tech was massively beaten up in 2022, how falling bond yields obviously provides a tailwind, and that some of the mega cap techs offer a safe haven dynamic in times of uncertainty. So that there are good stories around all these plays, but it does feel like a lot of that is in the price now. So I think from a tactical asset allocation perspective, yes, I'd agree with your observation that really you've got to see, either you need to see some catch up from the cyclical side of the market and a greater breadth there, or we could be at risk of tech actually catching down. Or another way to put it is, given we're in earnings season, I think it's fair to say that the bar is pretty high for tech earnings results. The onus is on them to come out with some pretty good numbers.
So again, you mentioned the NASDAQ, which is still up 15% year to date, and that may be on just playing catch up from last year, or perhaps it's on the thought that the Fed cuts rates later this year. What's your numbers tell you on that, and is there still more room to run for some of those big tech names?
Yeah, so we're in a bit of a tough bind on that, because the way we look at things is the first thing we do is we calculate macro warranted fair value. So the machine looks at where economic growth is, inflation is, credit spreads, the dollar, all these macro variables, and computes a fair value for any particular instrument. Now, the good news for tech bulls is that it's still pointing higher, that macro conditions are favorable for tech. The bad news is that at these levels, again, tech has run ahead of that improvement, and they're trading rich to our macro models. So on that basis, I think the way we would conclude it is these are not good levels to chase technology. Yes, they have strong underlying stories, but these are not optimum entry levels at all.
And Hugh, do you think that the investments that tech companies are making in AI, for example, which has been a hot topic of conversation, is going to further impact bottom lines?
Yeah, again, excellent question. I think that's that secular growth story, I think, has to be a big part of the price action in the last couple of months. The hype around generative AI is so big; it's such a potential massive game changer. That has to be part of the rally. Again, we would just question the degree to which it's already in the price at these levels. But I think, the trouble is valuing something like that is just so tricky. So again, I think we were just going to fall back on the point that, I think Meta might be a good kind of case study to look at. The feedback from Meta has been that this is a year of efficiency. It's a year of cost savings. They're going to try and help the bottom line that way. And now you see they seem to be taking a quiet pivot away from augmented reality and VR, and maybe towards more AI. I think that speaks volumes for where the focus is and where the top line growth may potentially come from.
All right, great stuff there. Hugh Roberts, Quant Insight, Head of Analytics. Good to see you, sir. Thanks for all that. And as mentioned we're just getting started here on Yahoo Finance Live. AI is coming. Alphabet CEO Sundar Pichai warning that society is not prepared for AI's rapid acceleration. We speak with the former Chief Innovation Officer of the FDIC about the implications of artificial intelligence. Plus, we check in on the housing market as the industry continues to be plagued by building material issues. Jerry Howard, the National Association of Home Builders CEO, with us later this hour. And love may be blind, but for investors, not so much. Netflix down today after its Love is Blind reunion was forced to tape due to glitches. A look at what the damage this could have for the streaming giant and what investors should expect when Netflix reports earnings tomorrow. Stay with us.
this is going to impact every product across every company. And so that's why I think it's a very, very profound technology. And so we are just in early days.
That was Alphabet CEO Sundar Pichai in an interview with 60 Minutes. Throughout the interview, Pichai emphasized the capabilities of artificial intelligence and warned that sweeping regulation is needed or society could face serious consequences. Joining us now is Sultan Megji, former FDIC Chief Innovation Officer and a professor at Duke University. Go Devils, good to see you, sir. So let's focus in on those that you think will be most disrupted by artificial intelligence. What industry or industries will be?
Well, it's a great question. And there are just so many. I don't think you can just say two or three. I will say any job where your primary function is sitting at a keyboard typing into something, you're going to be on the short list. There's just so many automations and so many streamlining functions that the current generation of generative AI have built that, everything from teachers to bank tellers to accountants, every single person is going to see some feature of their job change.
And that's certainly one of the concerns that many people see when they think of AI, correct? Whether or not it will be taking their jobs. But also, there's an ethical side to all of this, which has been brought up numerous times. Can you go through some of the ethical implications of AI?
Well, one of the biggest things that people are using AI for nowadays is to automate tasks that had historically been done only by people. And so when you take that decision making away from a person, let's say to get a mortgage, all of a sudden you have all sorts of questions. If the AI is trained only to maximize profit, will it be discriminatory, for example, or features like that? And so there are tremendous ethical questions once you start removing people from the decision-making process with these large-scale automations.
Elon Musk put it so mildly to Tucker Carlson, the downside is civilizational destruction. Sultan, what's your biggest concern? Is he overplaying the downside?
I mean, are we saying Elon Musk can be hyperbolic sometimes?
No.
No, the fact is every major technology change has disruption attached to it. We have never had a technology change that has wiped out humanity. And I tend to trust humanity to survive. Cars disrupted the horse and buggy. And guess what? Horses are having better lives because of it. We are going to discover that for the most part, artificial intelligence is going to make people's lives easier, make work more efficient, and make our civilization move more in a more streamlined way. Now, just like that clip you showed highlights, we need to have some degree of regulation so that it doesn't go out of control. But that's true with any technology, not just artificial intelligence.
So what would that regulation look like?
It's a great question. I don't think there's a great answer just yet. The European Union is putting forward some really interesting first steps on regulation. The Biden administration is not too far behind. And as a former regulator, I would really hope that we start on small, very narrow issues that define a playing field instead of saying something like, you can't use AI in banking or something, gross and silly like that.
But would the regulation come after the fact? I mean, so many times we see that something happens and then there's regulation. Or are you anticipating there be some sort of regulation in the meantime?
I think a lot of people are trying to figure out if it makes sense to put some regulation in up front. The problem is regulators by nature are reactive and not proactive, especially in the United States. And I think, the big conflict that we're going to see in Congress over the next year or so is going to be, can we get something passed through legislation that both sides can agree on? And it's not clear that we can.
Yeah, let's be clear. Congress is still trying to figure out social media, let alone cryptocurrency. So it's hard to imagine how far off actual regulation is here. I'm curious, as a professor, what you tell your students, what they need to do to be ready for this next wave, to be on the edge that takes advantage of it and doesn't lose jobs because of it.
Yeah, it is such a fantastic question. And, especially in computer science where the tooling is just moving so quickly. The other day I sat down to write my curriculum for the fall term and I used ChatGPT to help me. And I took what had been 10 hours of work and it took about a half hour. And if I can do that with a graduate computer science course on crypto, which is what it is, just imagine what, you can do in other areas. And so the one thing I tell all my students is focus on critical thinking skills. Understand that both the left and the right brain have to work together. You have to understand how the technology works, but also have read some Shakespeare. And if you can focus on the convergence of the technology and the tools with the applied side of what you need to get ahead in life, whether it's understanding business or a specific market or being a great doctor, then you'll be in a great spot no matter what happens with the technology.
Using it as a tool. And can you talk a little bit about deciphering information that's out there when it comes to AI? I mean, are we going to have, right now there is an issue with even figuring out what is fake, what is real. Are we going to have even a greater issue going forward?
We absolutely will. I mean, I was deep faked about a month and a half ago to show for a crypto project on a Twitter space. So, it happens to all of us. And just like a few years ago, we had to start getting smart about managing our passwords for all of our logins. We're going to start having to get smarter about understanding how to look at the provenance of the things we're looking at online and understand if you see a video clip of the president giving a speech, make sure that you understand how to analyze that so you know that that is in fact the president giving a speech and not somebody trying to manipulate you.
Wow, that is interesting. Another part of that 60 Minutes interview that really caught my eye was when Chat, or I guess it was Bard, they were examining, wrote a paper and cited 5 different books as sources. Well, those books never actually existed. What are the implications of that? And you as a professor, again, I go back to that. What do you do to check that your work by your students is actually being done by them and not a chatbot?
So it's funny, about 2 semesters ago, I had to start adding to the tools I use. So every time I get a piece of homework from a student, I run it through a series of tools to look for plagiarism, which we've done for more than a few years now, but also running it through tools to see if a generative AI system actually built it. I actually had to write a little program that kind of combines all of it and gives it a score. And then I give that back to the students and say, hey, listen, you're probably using one of these tools to help with your research. Well, don't copy and paste that in. One thing that we started to do that I get a kick out of is, if you remember when you're in college, those old blue books, those just pieces of those little notebooks with like 20 pages in them. I've stopped having students do finals online just because there's so much cheating and so much ability for these students to just copy and paste the right answers. And now they have to sit in the classroom with a pencil and actually just write down the answers without a laptop or anything in front of them. You can imagine the angst that I got the first time I did that.
The old-fashioned way, probably the way you and I have done that, Dave.
Absolutely.
Yep.
I'm taking notes right here, scribbling my notes.
Yeah.
So the professor would appreciate that.
Professor Sultan Meghji, thanks so much for joining us.
Thanks for having me. Have a great day.
You too. And House Speaker Kevin McCarthy speaking out on the debt ceiling, launching a new round of fight. What's at stake? Straight ahead.
It's a big week ahead for investors. Lots of earnings news. Of course, you've got the latest check on the health of the housing market and your taxes. Here's what you need to know. There's a big shakeup underway in the entertainment streaming business, and investors are hoping that hit shows like Beef
Let's make it stop.
will keep Netflix subscribers sticking around longer. The streaming giant reports earnings after the close on Tuesday. Another big earnings report to watch is Tesla. The company is set to release its financial results after the close on Wednesday, and we'll see whether Elon Musk's aggressive price cuts are hitting Tesla's profit margins. After recent volatility in the banking sector, many of the big banks kick off earnings season as well. Stay updated with Yahoo Finance as Goldman Sachs and Bank of America share their quarterly results. We'll get the latest housing numbers on Tuesday with housing starts and building permits. The market for new home building is expected to soften again. And on Thursday, existing home sales come through. And Tuesday, the 18th, is the deadline for filing your federal and state taxes. But because of severe winter storms, most of California and parts of Alabama and Georgia, they get an automatic extension until mid-October.
House Speaker Kevin McCarthy gave an economic address this morning at the New York Stock Exchange. He shared his plans for the House to vote on the debt ceiling. Let's listen.
In the coming weeks, the House will vote on a bill to lift the debt ceiling into the next year. Save taxpayers trillions of dollars, make us less dependent upon China, curb our high inflation, all without touching Social Security and Medicare.
We have Yahoo Finance contributor Kevin Sorelli with us. Kevin, so how close is McCarthy to getting a House deal approved on this?
I think it's just an opening to an opening bid based upon my reporting. Look, House Speaker Kevin McCarthy reiterating in a New York Stock Exchange address that he wants to see spending cuts tied to raising the nation's debt limit. And that is the Republican position. But Democrats are not on board with that. And in fact, the White House saying just within the last 24 hours that they feel Republicans are holding the nation's borrowing limit hostage. Democrats and Republicans have until about mid-August in order to straighten out this deal. But if they don't, they risk defaulting on the nation's debt, and that would be catastrophic to the economy. The Democrats and Republicans are each saying that neither side is negotiating with them, but lawmakers returned from recess this week, and so maybe, just maybe, those talks will finally get underway.
Good to see you, man. So the White House says McCarthy again failed to clearly outline what House Republicans are proposing and will vote on. Does McCarthy have any idea what House Republicans will vote on? And do you take this one seriously? Is it different than all the times that we've played this political theater game before? Because Kevin McCarthy has a very thin margin. He is skating on thin ice. Anything he does that falls out of line with the right, and he's out.
You know, I think that's a great point. And I interviewed House Judiciary Committee Chairman Jim Jordan, a Republican and ultra-conservative from Ohio, just the other week. And what he told me was that he ultimately thinks that the debt ceiling will get raised. And so I think that is a tacit admission on behalf of even conservative hardliners that ultimately the debt ceiling will get raised. They're not going into this and saying that it shouldn't, which would be, I think, from a market perspective, perhaps more even anxiety-inducing economically than the angst that and the turbulence that will likely happen over the next couple of months as a result of this. But even the hardliners are predicting that the debt ceiling will, in fact, get raised, which is notable.
Yeah, McCarthy may end up having to pass something largely bipartisan, a clean raise, which could cost him his leadership, quite frankly, in this wild House. He also talked about things that would make us less dependent upon China, which appears to be one of the few things other than TikTok, well, which I guess is related to China, that is bipartisan. Is there any knowledge or consensus around what Congress could do to make us less dependent upon China?
Well, look, there's been even in the last 48 hours, new news that is developed on the U.S.-China front. You've got senior staffers of congressional in both parties visiting Taiwan over the last several days. You have U.S. Trade Representative Tai visiting the Philippines, where obviously U.S.-China relations will be front and center. In contrast to that, China's foreign minister is visiting Russia. China's defense minister is visiting Russia this week and is scheduled to do so. So escalating tensions on that front. The FBI, mind you, just a couple of hours ago announced that they've arrested 2 individuals in New York for using police stations as a Communist Party of China front group. And so I think that as it relates to the bipartisanship on the national security front in terms of dealing with China, that remains strong. And as illustrated, I think just from anecdotally speaking, just the bevy of trips that have been made from the capital to Taiwan is incredibly notable, given the escalating tensions between China and the United States.
Could become really a central question of this next presidential cycle. Kevin Cirilli, good to see you, sir. Thanks so much.
Thank you.
All right, coming up next, we take a trip around the horn and check in on some top movers on the day in our triple play. Stick around. All right, time now for Triple Play. 3 stocks we're watching in the final 30 minutes of trading. Man U, Prometheus, Biosciences, and XPeng. My play is Manchester United, a 2-0 winner on the pitch Sunday, but big loser, as you can see on the market today. Shares down more than 11%. News reports suggest the Glazer family is scrapping a plan to sell the team, will instead secure a major outside investment that would allow them to maintain ownership and, according to ESPN, quote, double the value of the club over the next 10 years. Double it. Sky News reporting over the weekend that the Carlyle Group is in talks with Man U over a major investment. Other groups linked to potential investments in recent months include Alias Management, Ares Management, and Sixth Street Partners, so time will tell on all those. Now, while the Glazer family envisioned a bidding war emerging that topped well over $7 billion, that never really materialized based in part on doubt that they'd actually give up ownership, which is what we're seeing. A Qatari bid did emerge, as well as UK's richest man, Sir Jim Ratcliffe, said to be somewhere north of 5. The Glazer family paid around $1 billion for the club that is currently has a market cap north of $3 billion. This has been the story to watch in the UK, arguably the premier soccer club on the planet in terms of the branding and franchise. No, not the best on the pitch. But it's been a lot of intrigue, and I don't know which of you is I know you're a little bigger soccer fan, how you see this playing out.
Yeah, look, I mean, they wanted at least $6 billion. The reports are at least 6 or more, or north of that, and they are not getting it. And so they're going this route. I mean, what's been interesting is this whole kind of bidding process of what's transpired throughout this whole bidding process. To double it, I mean, that's
a heck of a plan by the Glazer family, isn't it, Allie?
Yeah, and a full buyout of the club, that would mean a big payday for all those shareholders as well as those controlling owners, which is why we did see shares spike last year on rumors the family was willing to sell the whole kit and caboodle. Not so much anymore, which is why the shares are a bit depressed today. But I was talking to you earlier about Ted Lasso. I know we're fans. I know we're not the biggest fans of this season, but maybe they could incorporate this into a storyline or something.
That would be good. AFC Richmond has let me down on and off the pitch this season. It's been a disappointing one as far as I'm concerned.
It's been a disappointing one. But you know who's not disappointed today? Our investors of my triple play, Prometheus Biosciences, a top trending ticker on the Yahoo Finance homepage. Shares are soaring today, up nearly 70% on news that pharma giant Merck will acquire the company in an all-cash deal valued at about $10.8 billion. The deal is expected to close in the third quarter of this year and comes amid an uptick of pharma-focused M&A. Remember, Pfizer acquired Seagen for $43 billion earlier this year, while Sanofi announced a $2.9 billion acquisition of Provention Bio back in March. And it is important to understand that deal-making overall that stalled significantly amid high interest rates, recession fears, geopolitical tensions, but there does seem to be signs of life in this market, especially with this Merck deal really demonstrating that.
Yeah, definitely. And it seems to be that Merck also is trying to just beef up its unit for immunology because it has the Keytruda, that's a cancer drug. It's a blockbuster drug. It's done really well, but the patent on it is going to expire by the end of the decade. So they are trying to find other ways to make revenue when that happens. So an interesting play there by Merck. And looking at shares of XPeng, those are up today. The EV maker plans to cut manufacturing costs. It unveiled a new manufacturing platform which will reduce the research and development costs of new cars. The new platform allows it to slash 25% of costs on its powertrain systems and also saves about 50% on intelligent driving features. Now, XPeng has been forced to focus more on costs since Tesla lowered the price of its vehicles. EV makers are in the middle of a price war right now, really.
Yeah, Elon Musk has really forced the whole playing field to kind of readjust what they're doing by cutting their prices. And Elon, in his last time we heard him talk about this, he said he's looking to cut production costs by 50% down the road. We haven't exactly seen how he's going to do that. There's some reports emerging that one way he's going to do it with cutting performance bonuses from Shanghai workers. And you can already imagine what they get paid. So that is not going over well. That's according to reports on social media. But when I was out at the New York International Auto Show, Ali, every single car maker I talked to said, look, I can't even tell you what the sticker is on this new EV we're rolling out because I don't want to say it publicly, because they were so afraid at the reaction being sticker shock because they were talking about an $80,000 SUV. They're trying to cut these prices down. They just don't know how. They're not at the scale. In fact, the two biggest EV debuts there at the New York Auto Show, they didn't release a sticker because they were so concerned with backlash to them.
It's so interesting. And, Tesla is the leader in this space. They've slashed prices 5 times since January, and that's obviously led to an uptick in demand. But the big question, especially heading into earnings, is what's the impact that's going to have on margin? So I think there's a lot to look at with Tesla overall and really the whole EV space at large, because there's this ripple effect that we always tend to see.
It's incredibly competitive in China. And the state of real estate. Up next, a temperature check on home builders as the latest sentiment reading edged higher this month. Stay with us.
Talk some real estate now. Home builder sentiment rose in April for the fourth consecutive month. The NAHB citing low existing inventory for driving confidence. Joining us now is Jerry Howard, National Association of Home Builders CEO. Jerry, always good to see you. So got the chart behind us of the home builders sentiment, and you see it ticking up quite a bit from the beginning of the year, but we are nowhere near these levels from January 22. Those were in the mid 80s. We're still in negative territory below 50. What do we need to get back up the mountain?
Well, building costs are still, I think, the strongest wind that's in our face right now. Building costs, because of material costs and labor costs, are really an issue. Also, there's still some unease in the banking community, and that's making it particularly difficult for builders at the front end of the pipeline, where they buy the land. Acquisition, development, and construction is the term of art. An AD&C loan, those are a little bit harder to come by. Mortgage rates are pretty steady, below 7. That's good. Not great, but good. But we still got to get the cost of capital for the builders themselves down. So cost of capital, cost of materials, cost of labor, those are the things that are bothering us right now. Then, of course, you add the regulatory environment. This administration is much more pro-regulation than the previous administration, and that adds to costs as well.
Jerry, Ines here. Talk to us a little bit about the cost of capital, the lending requirements that you were mentioning. I mean, how is this affecting the industry?
Well, I'm starting to hear more and more builders say that their banks, and builders generally get their loans from regional, small, local banks. As a result of the crisis out there in California, that a lot of the banks are being a lot more cautious about lending in general and to builders for acquisition, development, and construction in particular.
Boy, that is really interesting. I have not heard that to this point, Jerry. A lot of people wait for bank CEOs to kind of tell them about the state of the economy. What are your builders telling you that gives you a good sense of where this economy is headed?
Well, we had forecast going back to last winter that by the end of this year, we should be back to a pretty healthy housing economy. And I still think that that's the case. As I travel the country, as I talk to builders all over, the demand is there. The fact that there is so little existing inventory on the market is beneficial. So I think that if we can get some of these costs down a little bit, or at least in control, that we could have a pretty good fourth quarter and going into next year.
And you mentioned the building materials, that those costs are still high. Do you see relief on the horizon anytime soon? What are you forecasting?
We're very concerned about building material costs. The supply chain is still not back to what it was pre-pandemic. It's taking a long time to get things. Some of the geopolitical issues in the world are impacting the supply chain, and even our relationship with Canada and the possibility of getting more consistent supply of lumber from our Canadian neighbors to the north is problematic. So I don't really see a whole lot of relief on that front. So we're going to have to look at it from the regulatory front and the labor front, hopefully.
Of course, underneath all this, Jerry, are mortgage rates, which have been ticking down pretty steadily, but also appear to be leveling out a bit. Where do you think we'll be later this year in terms of the average 30-year fixed? And as long as it's above 6, is it going to be enough to unfreeze this market to get buyers and sellers off the sidelines?
We'd like to get it down below 6, obviously. I'm not overly optimistic that that's going to happen. But on the other hand, I'm not overly pessimistic that it's going to go higher again either. I think you're going to see mortgage rates stay in the mid-6 range.
And are builders offering incentives to buyers?
Builders had been lowering their prices pretty consistently over the fourth quarter of last year and into the first quarter of this year. That trend seems to be slowing down significantly. Other incentives that they were offering were upgrades on specific components of the house. I think that's probably going to stay in place for a while.
And finally, inventory been another major issue underlying everything. 1/3 of inventory new construction compared to a little more than 10% historically. Telling you what, and when does that dynamic change?
Well, that dynamic changes when people start to put their existing homes on the market, whenever that is. Right now, I think a lot of people who potentially would have sold and maybe downsized if you're a baby boomer are deciding to remodel, renovate, and stay in place. That's an issue, and it's only going to exacerbate the fact that we're about 1 million or more housing units short in this country. If we can't build more and they're not going to put more on the market, we're going to still have a bottleneck there.
Very interesting stuff. Jerry Howard, NAHB. Good to see you, sir. Thanks. All right, the Treasury Department revealing the list of EVs eligible for tax credits worth up to $7,500. The big headline, if you want those credits, you're going to have to buy American. Yahoo Finance's Praz Bermanian here to break it down for us. Praz, which vehicles are eligible? And that is a big driving factor in getting people to purchase EVs.
Yeah, I mean, a big part of it was the battery sourcing and mineral requirements, where they came from. The information that's been submitted from the automakers to the Treasury Department, and now through the fueleconomy.gov website, we see that there's only 11 vehicles that are available that you get the full tax credit for. We have the information here. So the Cadillac Lyriq, the Chevy Blazer, the Chevy Bolt and Bolt EUV, the Chevy Equinox, the Chevy Silverado, a couple plug-in hybrids here, the Chrysler Pacifica plug-in hybrid, as well as Lincoln Aviator, the Ford F-150 Lightning, and the Tesla Model 3 Performance, and the Tesla Model Y. So those are your vehicles that qualify for the full tax credit. Now, if you back out some of those cars that aren't actually out right now, like the Chevy Blazer and the Equinox and the Silverado, as well as these plug-in hybrids, only 6 pure EVs get the full tax credit in America right now, on sale right now. This actually goes into effect tomorrow. They released the names today. A couple of names like the Nissan Leaf, and the Volkswagen ID4 no longer qualify, right? The Rivian no longer qualifies, right? So it's kind of a big deal. These are kind of qualifications that sort of change over time as the rules change and automakers start sourcing from U.S. sources, from minerals to batteries. So this could change and expand, but it's not exactly the way you want to go if you want to expand EV ownership in the United States.
What about if you lease instead of buy? Do you get any breaks there?
Yeah, so leasing, there was a big exemption that Senator Joe Manchin is not happy about. But basically, there's a commercial lease exemption that allows you to get the full tax credit no matter what your income level is, no matter where the car comes from, no matter where the battery comes from. And it basically is a way for commercial operators to do that. But the way you and I can actually participate is if the captive finance company like Mercedes-Benz or Ford or GM, they are the lease operator and they lease it to you, they'll pass on the full credit to you guys when you lease it. So Mercedes CEO, the Porsche CEO, and also the Polestar CEO told me directly they're doing this, but they don't want to actually kind of say it out that much publicly.
Hyundai told me the same thing at the auto show, and they said it right into the microphone. Go ahead and lease. That's what we recommend. It is interesting, to your point, the Biden administration or their EPA wants to get, 2/3 of sales to be EVs, and yet their own rules take away the tax credits. Those seem in direct conflict to one another, right?
Yeah, I mean, basically, they don't want to subsidize foreign automakers and their cars, right, with using our U.S. tax dollars. So no one's stopping you from buying a Mercedes AMG or a Porsche Taycan. You just got to pay the full amount for it. If you want to get that Bolt or you want to get that Lightning, then they'll give you that tax credit.
Interesting priorities always. Praz Bermanian, good to see you. Thank you. All right, coming up, according to reports, Samsung is reportedly considering dropping Google as the default search engine and replacing it with Microsoft's Bing. We break down the lasting impacts this could have on the tech industry next.
As Google races to develop an AI-powered search engine, Samsung is reportedly considering dropping Google as a default search engine and replacing it with Microsoft's Bing. This is according to the New York Times. Let's discuss what this means for the future of Google and the tech industry with Roth MKM Managing Director Rohit Kulkarni. Rohit, thanks so much for joining us. We're looking at shares of Alphabet, which are down right now. So what would the impact to Google be if Samsung pairs up with Microsoft's Bing?
Hey, thanks for having me. I think the impact on Google is less material if Samsung decides to move away from Google. It's probably $1 billion, less than 2% of revenues. But I think the perception, the sentiment impact, which is what showcasing in the stock right now, that's more important. What happens if Apple starts to negotiate or renegotiate the contract which they have similar to what Samsung has? What happens if other companies start to do that? See it, Firefox, Mozilla, and so on and so forth, where Google search has been the primary gateway to all browsers across mobile and desktop. So that's where the big debate is, and that's what's being kind of priced into the stock via a lower or a more negative sentiment, I feel.
Do you expect Apple to do so?
It feels highly unlikely in the near term. At the end of the day, if I were Apple, I'm most worried about my users and my consumers' experience, what gives them the best experience right now, and whether there is an experimental change into the way people search on the internet through a chat type interface. That remains to be seen. That's probably several quarters, if not several years out. But I think in the near term, I feel Apple and Google, their relationship is pretty tight and should remain tight. Perhaps there are some economics that could change, that could again go back to Google's sentiment. But I feel that's the biggest debate, and that's the multi-billion-dollar question.
Key word you use there is perception, and there's a perception industry-wide that Google is just behind the 8 ball when it comes to artificial intelligence, most notably to Microsoft because of what they have going with ChatGPT. Is that perception reality?
In my opinion, and here in Silicon Valley, what I would say is Google has always been regarded as the leader in AI. They have been the forefront of AI research for probably several years, even before we heard of ChatGPT, before OpenAI started what they were doing right now. The core technology, the core research on which ChatGPT is based was in a research paper that Google published maybe 7 or 8 years back. So the point is, I feel Google remains the leader in AI. The perception has changed simply because they haven't unlocked direct-to-consumer use cases, direct-to-consumer apps that are sexy and cool for people to tinker with, like ChatGPT has. And that's where they're behind this PR campaign that probably they need to be more aggressive with. Yesterday's interview with the CEO was okay. I think they can definitely do better, I would say.
So is this a PR campaign that they have to go through? I mean, so you're saying they're a leader, they've got the technology, and this is basically a PR campaign. So what we're seeing with Samsung, said another way, what we're seeing with Samsung and the possibility of Microsoft Bing, is this sort of a negotiation tactic, perhaps?
So two things there, in my opinion. One is what Samsung hopes to achieve. In my opinion, all they want to achieve probably are better unit economics, better treatment, and better relationship with Google. They have been with Google and Android for more than 10 years. They've had this love-hate relationship with their own Samsung's own AI efforts, their own chat efforts, their own assistant efforts. So I think at this point, all they need is a little bit of extra love from Google, be it a slightly better relationship, better economics, first pass at new AI efforts that come from Google. That's one. And then when it comes to Google's own PR, I feel what they are behind the 8 ball, as you just said, is what products can they directly bring to market with exclusively AI-first native AI applications and let consumers play around with them. It could be image generation, it could be video generation, it could be chat, it could be a lot of those things. I think they just need to kind of, I would say, unlock their AI kimono in a way that people get confidence that Google is actually the leader in AI research and products. Right now, that's on shaky grounds.
You've got a buy on Google, on Meta, on Amazon. Is that largely on the AI story, or is there something else in the macro that bonds them together?
Again, I don't have a macro crystal ball. If we are heading into a recession, then probably very few companies or their stock prices work in the way people want them to work. But having said that, these are the three kind of pillars of AI research in a way that they have the data, they have the consumer behavior, and understanding of shaping consumer behavior in a way that not many companies have. So they have, I think AI is definitely going to be unlocking new use cases, new ways for them to make money, new ways for them to change consumer behavior. And those three companies, definitely, there is an AI bent to it. Again, each of those companies have their own issues going on, but I would say, if asked, what is my order right now? I would say all else equal, Amazon, then Google, and then Facebook in terms of preference of the mega caps.
And I'm sure we'll be hearing much more about AI and these mega caps. Rohit Kulkarni, thanks so much for joining us. Coming up, we're counting down to the closing bell on Wall Street. Stick with us on Yahoo Finance Live.
All right, we're coming up on the closing bell on this Monday, and everything moving towards the positive the closer we get to it. You can see the Dow up almost 100 points, the S&P and the NASDAQ up about 1/3%, and there is your closing bell on Wall Street for this Monday, the 17th.
And looking at the market action, we are seeing the sectors that won today, those being real estate and financials. Those were the leaders throughout the session today. And energy, communication services, and healthcare, those were the laggards.
All right, big banks have been the story thus far in the quarter. Today we got State Street, M&T, and of course we got Charles Schwab. Reportings were mixed, exceeding expectations on the bottom line for the first quarter. The company also announced it will pause its share buyback program amid the recent banking crisis and regulatory uncertainty. A winner on the day, if there was a loser, it certainly was State Street, but Charles Schwab really emerging not hurt.
Yeah, not hurt. Charles Schwab, we should say, really took a blow during the financial crisis that we had recently. I mean, along with the regional banks, and that's because of its positions with bonds. But they came out early on and said, look, we've got plenty of liquidity. We don't have to sell bonds prematurely. We're fine. But still, the stock year to date is down about almost 37%, 36% right there. Lulu.
Well, just real quick, wanted to add, we're watching deposits down 30% in Q1 from a year earlier, and 11% since the end of last year. Go ahead.
Lululemon is reportedly in search of a buyer for Mirror, the fitness equipment maker that Lulu acquired for $500 million back in 2020. According to Bloomberg, Lululemon is working with an advisor to solicit interest in Mirror. The at-home workout program has missed sales expectations since being acquired and costs Lulu over $400 million in impairment charges during the fourth quarter. When that deal came out, you remember that? I mean, that was just the deal of a lifetime because it was Peloton was in the scene, and this was going to be a competitor, and it just was.
That really is what drove it, isn't it? Peloton. And it was in 2020 when we were home, when this was a different world and one that we thought, at least people like Lulu and Peloton and others thought would continue forever, and it did not. $500 million purchase looks like a straight write-off. To your point, it was the last earnings report that we saw that specifically a $442.7 million, as they called it, post-tax impairment charge. Their CFO said, overall, the at-home fitness space remains challenged. Yeah, to say the least, this was a terrible purchase. The world has changed. They're going to continue with this app, but now it won't have the hardware required. Who's going to buy this thing is the question, and how little will they settle for?
Well, you know, in a recessionary kind of period, it's difficult because people are also watching what they're buying. But nonetheless, the issue is that it was during the pandemic. Everyone was home. We thought that this was going to be sort of the trend. Everybody was going to be working out from home for years to come.
I'll admit, I thought that trend would continue. I'm a workout at home guy, and I am happy to do that forever. And I know a lot of people that did move to working out at home during the pandemic have decided, oh, I really like the 30 or 40 minutes I got back in my life that I don't have to travel to a gym, the $100 a month that I have to spend on a gym. But what we've seen coming out of the pandemic is people want to live, they want to experience, they want to travel, and apparently going to the gym checks that box too.
And
Not mine, but others.
You have to have discipline. If you're going to do this at home, you have to have the discipline. And for a lot of folks, I think it was just, oh, I'm going to use this as an accessory in my room.
Now you just have a really expensive mirror on the wall
exactly.
to
Very
check out your
mirror.
outfit. It doesn't look like much of a future there. All right, on the other side of things, if you're not getting in shape and you want burgers, well, we've got your story. If you were loving McDonald's already, it may be in for a big-time quality upgrade. The company announcing today some small but tasty improvements to the Big Mac, McDouble, and all their burger items. The updates include softer buns, cheese melted to perfection, onions added on the grill, not after the fact, and more of everyone's favorite Big Mac sauce in every bite. Not much of an investor story. The stock, not much movement on this action, but some good news. Yeah, up just a bit. It was hovering around the neutral point all day long. But for customers of McDonald's, certainly some good news. And the marketing story here, the Hamburglar is back. He's back in the marketing profile, which excites me very much.
I think this is important because, look, people are tightening their belts. They are watching what they spend on, as I mentioned earlier, and even in this price point, even when you're talking about McDonald's, because we know that the prices have been going up across the board, across all restaurateurs. And so if you are going to spend the money on a burger, you want it to be, you want that cheese to be warm, you want the onions to be grilled.
Yeah, I just as a burger connoisseur, I do notice a lot of times at McDonald's the cheese isn't melted, and that is worthless. You can't put the cheese on after the fact. And the onions, the same thing. I think they're the problem here, and again, breaking down the burger, I lose a lot of sleep over this. The onions on the McDonald's burger always kind of were crunchy, and instead you want the flavor to seep into the burger. You don't want to crunch on those onions after the fact. So good news, I think, for fans of McDonald's. I don't know about the more sauce, though, on the Big Mac. That takes away from the flavor of the burger, but maybe you're trying to mask it a little bit. I'm not sure.
Dave, as a connoisseur.
It is. I got a lot of thoughts on this, man. I could write a novel here.
They need to be talking to you. Investors are keeping a close eye on banks this earnings season amid the recent turmoil in the sector. And it was a rough day for State Street. Shares ending the day down more than 9% lower after the bank missed estimates on both the top and the bottom lines. Joining us now, Michael Rose, Raymond James Managing Director of Equity Research. Michael, is the banking crisis over?
Hi, thanks for having me. Yes, we think we are moving from the crisis phase to the stabilization phase. And I think as we move into earnings season, what we're going to see is, trends that we expected to envelop as the banking crisis did play out, which is deposits, meaning deposit flows, deposit costs, and the mix of deposits changing from those that are non-interest bearing to interest bearing, as we essentially believe that we through this crisis, through the Signature and Silicon Valley bank failures, that we kind of woke the sleeping bear as it relates to those that had not yet, looked to ask for a better rate from their bank deposit side. We think this crisis spurred that action among small businesses and consumers. And we believe as earnings season plays out that these trends will become much more apparent as the regionals and the smaller banks begin to report.
Yeah, we've seen certainly deposits slip a bit across the board, but no huge damage from the banking crisis. But I would say yet, as a lot of analysts feel maybe the damage is way down the road when conditions begin to change over time, that we haven't seen it yet because the damage hasn't been baked in. When will we see the true impact of what happened with SVB, and what will it be?
Yeah, so we continue to believe that the two banks that failed, Signature and Silicon Valley, were idiosyncratic in nature. They had specialized business units that were concentrated in specific industries. When you look at the industry at large, we actually think the deposit flows have actually begun to stabilize. And just looking at the Fed's weekly balance sheet report, you can see that in each of the past 2 weeks, small bank deposits have actually increased. And we think that is very, very important as we move through the next few months to quarters. Again, we think the bigger issue is the change in mix from those that had deposits sitting in checking accounts that are now moving to an interest-bearing account. And then also the cost of those deposits, just given the upward pressure on rates, competitiveness, and then in the face of the Fed, looking to raise, potentially one more time before taking a pause.
So if market watchers are looking at a bifurcation perhaps of the big banks and the regional banks as we were coming into this earnings season, is that bifurcation not as severe perhaps as one would have expected?
Yeah, we don't think it's as severe. Clearly, the regionals have been under an inordinate amount of pressure. If you go back to Friday, you had Citi, you had JP Morgan, both beat on kind of the top and bottom line. The shares were up, fairly considerably, outperforming on the day. But the regionals and the smaller banks did lag. Today, we've had, quite the reversal. And again, we think this marks the shift from the crisis phase to the stabilization phase, and realizing that, things aren't all that bad. There are definitely headwinds in the form of net interest margin pressure, slowing loan growth, pressure on expenses, and fee income businesses, which have been soft. Those are earnings headwinds. We don't think they are liquidity or capital headwinds. So given the sell-off that we've had in banks over the past 5 or 6 weeks, coupled with the underperformance that we've had last year, there are some relatively attractive valuations. We would say that concerns on credit are persisting and just beginning to pick up. So we think that is going to keep investors at bay for now. So valuations will remain depressed in kind of the short to intermediate term. But once we figure out how bad credit will be, we actually think that you can perhaps begin to look at this sector, which has been an underperformer for quite some time.
Speaking of, the Treasury Secretary Janet Yellen, speaking to Fareed Zakaria at CNN, said, quote, banks are likely to become somewhat more cautious in this environment. We already saw some tightening of lending standards in the banking system prior to that episode, and there may be more to come. How do you expect that story to play out?
Yeah, we definitely believe that there is going to be a slowdown in loan availability and therefore loan growth at the banks. given just what has happened here over the past 5 or 6 weeks, we believe that it has accelerated what was already beginning to play out. Concerns around a recession had been building for the past several months. This likely has brought them forward. And given the increase in deposit costs that banks are being forced to pay, the new loan yields that banks are underwriting new loan production at have definitely moved higher, in some cases in a marked way, just over the past 5 or 6 weeks. So, we think that the buyer, the customer, whether it be business or consumer, willingness to take on new credit at 7%, 8%, even 9% in some cases is certainly less so than it was at 4, 5, or 6%. So by definition, we think that lending activity will likely slow over the next month to a few quarters.
And do you see that slowdown happening in certain areas? For example, we spoke with Jerry Howard, the National Association of Home Builders, and he was saying that that the lending in commercial, or the lending, for builders has been a concern. We've got that concern. Then, of course, we've got the commercial lending as well. So which areas are you seeing that there might be more tightness?
We think it's going to be fairly broad-based. So the consumer spending that's happened since COVID appears to finally be slowing. The excess cash that was built up during the pandemic through a variety of stimulus programs is being run off given the impacts of inflation. On the small business side, continue to see some pressure, but I think what you're probably getting at is concerns around commercial real estate and more specifically office. That is an area that has dominated news headlines here over the past 3 to 4 weeks. Commercial real estate, though, is a very broad asset class. And so we can certainly understand the concerns around office in metro markets. But I think overall, there's going to be less just commercial real estate in total, just given increasing signs that the economy is beginning to slow down. Again, we don't think it's going to fall off a cliff, per se, but definitely a slowdown, and we'll have to determine, over the next few quarters if we actually do approach a recession.
All right, got to leave it there. Michael Rose from Raymond James. Good to see you, Matt. Thank you. Coming up, Montana passed a bill to ban TikTok on all devices in the state. We'll discuss the impacts and how they actually go about it with Montana Attorney General next.
Apple getting deeper into your wallet with a high-yield savings account, but it might not be as straightforward as you think. Ali Garfinkel is here with the details. Ali.
Hi, Inez. So this announcement in some ways seems so simple, but actually there's a lot going on under the surface. And I want to start by breaking down what this actually looks like, what this Apple savings account really entails. So first things first, if you don't have an Apple Card, this is not for you. This is specifically for Apple Card customers. And the thing that everybody's going to remember, of course, is the 4.15 annual percentage yield, APY. However, the thing I'm most interested in are some of the mechanics here, right? You have the fact that it's accessible from the Wallet app. I know I use my Wallet app for a lot of different things, but I didn't know this was something I could use it for. But as it turns out, now you can. And consumers can actually open an account starting today. There are also no minimum fees or deposits. And this savings account is actually not managed by Apple. It is technically being managed per the FDIC by Goldman Sachs. So why is Apple doing this, right? I think there is a very simple explanation from Apple's end, and it's all about that vaunted Apple ecosystem that is taking its reach further and further. I think the more interesting question is why Goldman Sachs would be doing this. And I think it comes down to that long-standing effort on the part of Goldman to really push into more consumer-facing areas. And it's something that they haven't necessarily been successful at. For instance, this is kind of a second chance, actually. Let's go back to January, right, where Goldman actually shuttered its Marcus consumer loans business. Apple, on the other hand, right, not historically a bank, but is unsurpassed in making consumer products that are sexy and easy to use. So this is also happening at a moment, I think it bears saying, where the banking system as a whole is really unsteady following the collapse of SVB. And as we've referenced so many times on this show, the continuing uncertainty surrounding regional banks. So the bottom line here, I would say, is that arguably, right, we have the most trusted tech brand that's expanding its reach with what's arguably the most famous bank in America at a time where the banking sector is really vulnerable. The way I sort of read this in the end is that together Apple and Goldman are trying to create a fintech-style offering, which for both of them in the end could make a lot of sense.
Thank you, Ali Garfinkel, for that breakdown.
All right, Montana passed a bill to ban TikTok on all devices in the state. The bill now awaits the signature of Governor Gianforte. So how and why do they want to do this in Montana? Joining us now is one of the biggest proponents of the ban, Austin Knudsen, Montana Attorney General. Nice to see you, Mr. Attorney General. So let's just start off with the obvious. Why is it important for Montana to ban the social media app?
Well, this has got nothing to do with TikTok's content, although I certainly can make an argument for that and why my teenagers don't have TikTok. But we know that TikTok is a tool of the Chinese Communist government. That's what this comes down to. TikTok is a pernicious spying application that is used by ByteDance. And under Chinese law, if the Chinese government asks for it, ByteDance is required to turn that information over. So what kind of information are they collecting? Well, the more and more we dug into this, the more horrified we became. And it's right in their user settings. These aren't optional. You can't shut them off. They are collecting biometric data from you. They are logging your keystrokes on your phone or your device. They're scanning every app that you have open on your phone. They're scanning your pictures and your videos for intelligence and stuff that they can use for the military. This is all scary stuff. And as I said, this is not something you can opt out of like you can with a lot of the other social media giants that are out there. So this is quite concerning for us in Montana, just from a privacy standpoint, and the fact that it's basically controlled by an enemy foreign government.
And what is your fear that Chinese officials in this case might do with that data?
I don't care what they're going to do with it. That's not the issue. I wouldn't let my neighbor have access to my pictures and my personal information on my phone. The fact that it's an enemy foreign government should be frightening to everybody. I think every Montanan has privacy concerns about anybody being granted surreptitious access to their applications and to their personal information, to their children's photographs on their phone. Why in heaven would we want that information to go to a espoused enemy government? China considers the U.S. an enemy. no matter what we consider them, in their military doctrine, they don't refer to the U.S. as the U.S. They refer to the U.S. as great enemy. That's their words. So why in heaven's name would we give them intelligence off of our phones and off of our devices here in the U.S.? That's what this comes down to.
Great enemy. That I have not heard. TikTok spokesperson says the bill's champions have admitted they have no feasible plan for operationally doing this to censor American voices, and the bill's constitutionality will be decided by the courts. At the heart of this is how. How in the world do you actually ban it? Do you need Apple's help?
Well, the quick answer is yeah. We do have a plan to operationally do this. They don't like it. TikTok doesn't like it. Apple doesn't like it. Google doesn't like it. But that's what's going to happen here. If this bill goes into effect, and again, it has to get signed by the governor. That hasn't happened yet. But if it does go into effect, our enforcement mechanism will be not on the end users. This law would specifically prohibit us from going after individual Montana users, and we wouldn't do that anyway, but that's precluded. This would put the onus on TikTok, and it would put the onus on Apple and Google. Basically, if you're providing access and providing download, it's a $10,000 per day civil penalty, and that's how we would enforce this. So this would be done through the Montana Office of Consumer Protection, and we'd be looking at civil penalties on these companies if they do that.
Just want to be clear, you're prepared to fine Apple and Google $10,000 a day for not helping you. Have they had a response to this?
Well, their response has been, we can't do it. We don't know how we're going to do this. And Dave, that's just not true. First of all, those platforms regularly censor and block certain applications every single day. But their biggest hang-up has been, how are we going to do this just around Montana? We can't do that. Again, not true. There's all kinds of gambling and sports betting applications that are legal in one state but not legal in the next state. And Apple and Google are able to geofence those states out and make it so those applications can't be downloaded and so they don't operate in those illegal states. So we're not asking that anything new be created here. This is technology that exists. It's methodology that exists. I get that Apple and Google might not like it because they're getting a lot of Chinese money from TikTok. But that doesn't change the fact that that's how we're going to enforce this, yes.
Presumably they would incur a significant cost to do so. But to my read of the bill, it does not ban or not do anything to address the thousands, let's say hundreds of thousands of Montana residents that already have and downloaded the app and participated on every day. Has the horse already left the barn, Austin?
Well, I think what we'd expect here is that the app would no longer be able to function. But I mean, I'm sure there's going to be some workarounds around this. And look, we are under no illusions here. I think this is an issue that the courts are going to get involved in. I think it does bring up some really interesting First Amendment jurisprudence issues that we probably need the courts to step in on. We probably need the U.S. Supreme Court to tell us, are these social media giants just simply private companies that can pick and choose as they want, or are they actually the new town square that are a public utility and necessary for free speech? There's some really interesting legal questions here, and I'm sure that if this bill goes into law, we're going to have some challenges. I'm sure we're going to end up in federal court. We anticipated that when we brought this, and we're prepared to go down that road. But yeah, I think there's definitely some people in Montana that use it. But again, we're precluded. We're not going to. We have no intention, nor are we allowed under this law, if it is to go into effect, to come after and prosecute individual TikTok end users.
This certainly presents some very interesting legal questions moving forward. Montana Attorney General Austin Knudsen, really enjoyed the chat. Thanks so much.
And Roblox shares ending the day 12% lower after releasing its March metrics. Yahoo Finance's Rochelle Akufo is here to break down the report for us. Rochelle.
Hey, Inez. I mean, in fact, the monthly metrics themselves actually weren't that bad. We saw estimated bookings and revenues, $4.8 billion 4.8 billion hours engaged by users there, versus the 4.6 billion in February. But investors really honed in on the drop in DAUs, or daily active users, at 66.2 million versus February's 67.3 million. Now, in a press release on Monday, Roblox noted that foreign currency fluctuations put about a 2% dent in the year-over-year growth rate for March 2023 revenue and bookings. But note some nuance here. When they refer to bookings, they're referring to the money used to purchase credits in a game ecosystem, or Robux, in the case of Roblox. Now, the March forecast of 247 million to 255 million, that was up slightly from February, and on a year-over-year basis, up 23 to 27%. The problem is, it doesn't actually show up as revenue accounting-wise until a user spends those Robux. And since revenue is more reflective of a company's growth, it does make it harder for investors to gauge how to value Roblox, especially given this business model. Now, of course, if you look at the broader tech atmosphere, some of the drop might be part of an overall pullback on risk, because it is actually faring very well year to date. It's up more than 40%, and that's even including today's drop, Dave.
Very interesting. So Roblox says essentially they're out of this. No more monthly key metric data. Why?
Well, this is interesting. So they seem to be wanting to take a longer view versus a monthly view. Some of the nuances and some of the changes in that. So in that same press release, they said, quote, while we believe that this has provided incremental information to investors regarding the seasonality of the business, we have decided to cease providing key monthly metrics to align our reporting cadence with our value of taking the long view. So now what will happen here? Well, investors essentially will have to wait for the quarterly metrics and get those as they do along with the other quarterly disclosures, things like the shareholder letter and some of these other quarterly publications. So you won't get to see some of these details month to month, but it's not going away. You just have to wait for the quarterly reports.
Makes some sense. Rochelle, nice to see you. Thanks so much. All right, Hollywood faces its first potential writer's strike in 15 years, but could that help the studios? We'll break that down for you after the break.
Welcome back to Yahoo Finance Live. Hollywood faces its first potential writer's strike in 15 years. The Writers Guild of America members voting to authorize a strike if a deal with the studios is not reached by May 1st, with nearly 98% voting in favor. Yahoo Finance senior reporter Ali Canal joins us now. So Ali, how would a strike now be compared to the one in 2007, 2008?
Well, the environment today is much different than it was 15 years ago. And you see that demonstrated in the catalyst for this potential strike, because one of the main reasons that these writers are fighting is because of the payout structure that writing is currently under right now. That hasn't been updated to account for the streaming boom that we've seen, along with this recent refocus on profitability. On the one hand, you have entertainment giants like Disney, like Warner Brothers Discovery, slashing costs, announcing mass layoffs, shelving shows and movies, which means less work for writers. And then on top of that, streaming shows take a lot longer to produce and they have less episodes. Remember, peak TV times, you had episodes of Friends that ran 20 to 25 episodes in one season. Now with something like a Stranger Things or a Ted Lasso, you have 8 to 10 episodes at the most. And in addition to that, the residuals for streaming shows are a lot less than traditional TV. So not only are you having less work for writers, but also less pay overall. Now, with this authorization vote passing, it is widely expected that we will see this strike happen in early May. If you remember the impact that that had back in 2007, we had seasons cut short, backlogs in content, the late night shows were shut down, and all of that would happen again with really the only savior here in terms of content being reality TV, since that doesn't, necessarily need writers. So a lot more Love is Blind season to come. But another thing to remember here is that these contracts are updated every 3 years. 3 years ago, we were in the middle of the pandemic. So really everyone was on the same page of just wanting to keep the peace, get back to work. But now we still have the same issues that we had 3 years ago in 2020.
More reality is just what the doctor ordered right now. So there is some theory that this could actually help the studios. Why and how?
Very interesting note here from Rich Greenfield from Lightshed Partners. Now, he basically said a strike would be a net positive for a lot of these companies that struggle with profitability on their direct-to-consumer side. Again, since we're operating in this environment where streaming has become more a part of these companies' bottom lines, but you want it to be profitable, this could be a way for them not to necessarily not bear the cost of all of these shows, because if you're not bringing new content on the platform, you're then not paying for that content. So that helps with free cash flow. That helps with your operating margins. Yes, you're going to have stale content. You're not going to have new content. That could potentially impact subscribers. It could lead to increased churn. But remember that investors, they don't really care that much about subscribers anymore. They want to see an improvement on that bottom line. And Greenfield basically arguing that companies like Paramount and Warner Brothers Discovery would benefit the most considering their balance sheets. But it's this weird roundabout way of, how this could potentially help given the environment that we're in right now.
I see the investor angle. It's just a little bit icky from a writer's side. And
also, another thing to note is internationally, these strikes and negotiations, it doesn't impact international writers. It doesn't impact international content. Who has been the most successful with international content? Netflix. So that could be a competitive advantage there as well. So very interesting note here.
See, she queued us up to our next story. That's how Ali Canal does it. Thank you so much. All right, coming up, love is in the airwaves. Almost. We break down the debacle surrounding Netflix attempt at a live broadcast and the impacts it could cause for the future of the streaming giant. Love may be blind, but for investors, not so much. Shares of Netflix took a hit today, down about 2% after Love is Blind reunion. The live show was anything but live. Netflix tweeting, quote, "To everyone who stayed up late, woke up early, gave up their Sunday afternoon, we are incredibly sorry that the Love is Blind live reunion did not turn out as planned." So what's the damage here, and what should investors expect when the streamer reports earnings tomorrow? Citi Managing Director Jason Bazinet and Annandale Capital founder and chairman George See join us now. Good to see you. George, I know you're a huge fan of the Love is Blind franchise. You never miss a single episode. What's the impact of this mess up last night that really was viral?
Yeah, thanks for having me on. Yeah, I not only don't miss it, I tape it so I can watch it again and again and again. I think it's inconsequential. I think Netflix stock has been a huge winner for investors over the last year and has a great long-term future. Our team here loves the stock. If I was an investor, though, I would temper my expectations for the next 6 to 9 months. It's had a huge run. It's probably going to have to process and correct some on the going forward basis unless they just nail their earnings, because the multiple the street is going to assign to this company really depends on how fast they're growing.
Jason, do you agree with George's assessment that it's inconsequential? I mean, what is the future for Netflix when it comes to live?
Yeah, I think it's totally inconsequential. No one likes to see customers get disappointed, but live is a very, very small percentage of all the hours that they stream. We know technically it's possible to do live events over the internet. So it's just a matter of, provisioning sufficient capacity and fixing it. But it's just a minor blip, not really material for the stock at all.
It ain't easy being live. George, more on your outlook for Netflix. Why the slightly bearish outlook?
I just think anytime a stock doubles, a very mature large company doubles in a year, you have to start getting cautious unless it starts trading at 5 times earnings. And Netflix got down in the low teens kind of earnings multiples, but it never got into single digits. And now it's back up to 25 to 30 times earnings, depending on what they earn going forward. So I just immediately get, unless the company's growing it close to its multiple, I want to get more cautious about that. And we still hold the stock, though. We haven't sold any stock. We wrote some put options on it, and we hold the stock, and we continue to hold the stock. So we like the company, and we think it's one of those few American companies that's going to be around for a long time and generate gobs of cash flow. And I saw that y'all published an article today that basically said that one of the great big factors about how great Apple is as a company is how much stock they buy back. And I would encourage Netflix management to look at it the same way. Use a lot of their free cash flow to buy back their stock.
Is there anything, though, that could change your short-term bearish call in that earnings report tomorrow, George?
Yeah, if they blow out the numbers way beyond the beat that the street's expecting, I might change my tune a bit, but not aggressively so. As the stock goes into the high 300s or low 400s, if it gets there this year, I'd be a seller of at least some of my position in that kind of range. But right now, we're happy to hold. And I would say also on the live streaming snafu, I'm sure Hollywood is snickering today, and they're getting some short-term points for beating up their competitor. But as we said, it's just going to be here today, gone tomorrow for Netflix.
And Jason, you have a buy rating on the stock. So what are your expectations for when they announce? What are you looking for?
Well, I think the challenging thing for Netflix to me is that this story used to be real simple, where the street would just measure net additions as a proxy for how healthy the company is. The problem right now is you've got two narratives running through the net ad number, right? You've got the ad tier, which I think is going to be quite positive for net ads over the next 3 to 4 years. That's the signal. The noise part of it is they're simultaneously cracking down on password sharing, and that causes near-term churn to go up. And so it's going to be a little bit challenging for the street to try and interpret these numbers when you have these two initiatives running through the income statement at the same time. So I think George is right. Like, you could end up having a little bit of a pause. I'd even go one step further and say that the trouble for the street, and the thing they're really focused on, is when are they going to crack down on password sharing in the United States, their biggest market. As soon as that happens, the churn rate's going to go up. So what does that mean heading into this print? If they end up smashing expectations for Q1, but then they announce that they're going to crack down on password sharing in Q2 or Q3, the street's going to be unwilling to sort of extrapolate that subscriber growth or strength into the second or third quarter because they're going to say, well, the password sharing crackdown is going to cause more churn. And so we just need to get through all of this password sharing noise and just get back to the signal, which is the benefit of the ad tier.
And George, what's the one either number or piece of commentary that you will be zeroed in on when they report?
Boy, that's a great question. I don't think I have any one thing in particular I'd like to point to. I said about 6 months ago to you all on this same security that I want to see how management executes. I think how the leadership of Netflix runs the business and how they perform up and down the value chain in terms of revenues, margins, ads, everything that they do to produce a higher earnings capacity and a higher stock price. I'm going to be paying keen attention to, because I think it's gotten large enough to where great management can really make a difference at these levels. I think it's made a difference at Apple. I think it's made a big difference at Microsoft. And I think that's a big factor in terms of what kind of multiple the street's going to give this company going forward, because I think that's very uncertain. And I think that at under $200 a share, I could stand a lot of uncertainty and not worry about it. But at $330 or so, it gets more troublesome and difficult.
And Jason, we were just talking to our reporter, Ali Canal, about a potential writer's strike. How would this affect Netflix?
Yeah, I don't think you want a writer's strike. I understand the comment you made about Rich Greenfield saying it'd be good for cash flow, but and that's just sort of tactical. But I think at the end of the day, the street doesn't like the uncertainty that comes with a strike. It's going to just inject more noise as the cadence of new content slows down. It might help margins, but generally the street doesn't like strikes.
Indeed. All right, Jason Bazinet, George C., good to see you both. Thanks for that conversation. Coming up, a recent report estimated that up to 25% of current office stock could soon become obsolete. So what does that mean for the future of the office real estate market? We'll discuss that next. A staggering number, up to 25% of current offices could become obsolete by 2030. That's according to a recent report by Cushman & Wakefield. So what happens to this space? Joining us now is Xander Snyder, First American Financial Corporation Senior Commercial Real Estate Economist. Xander, good to see you. So do you buy that analysis, and what are the implications if that were to come true?
Thanks for having me. Yeah, I've read the Cushman report. It's a really solid report, and I think that they're in about the right area. There's a lot of office stock that is in the process of obsolescing. There's a lot that is physically still quite underoccupied compared to pre-pandemic levels. And I think that perhaps is more of a medium-term problem. In the nearer term, more of the challenge is cash flow plus upcoming debt maturities.
And do you think that hybrid is here to stay when it comes to these office spaces? Because we have seen companies calling people back to the office in a recessionary or slowdown environment. One would think that perhaps office workers would be more willing or apt to go to the office. So looking ahead, is this a trend that is staying hybrid, or is this something that could change and you could see office occupancy go higher?
I think it's natural in the course of business cycles for, in downturns, employees to lose some leverage, employers to gain some leverage, and vice versa. Right now, the labor market remains quite tight. Unemployment's below 4%. A lot of folks who left the labor force are not back in it. So looking in the long term, what does that mean? I think that the technology that enables remote work and hybrid work situations is essentially out of the box. There's no putting it back in the box. And in the future, it'll just be an additional knob that employees and employers can turn when negotiating contracts. Some folks will value money above other things, and some folks will value remote work above money. And so I think it's going to be flexible in the future, but it's not going anywhere. The technology is here.
Right, and that number, and I watch the badge swipes, as I'm sure you do, the 10-city average, it's plateaued and it's stuck below 50%, somewhere around 49. So even if you crank that knob, it'd be hard to imagine getting anywhere near 60%. What does that mean for the office space?
I think you're exactly right. During the pandemic, a lot of us are watching this expecting the return to work, the return to the office to gradually drive those numbers up, and it just hasn't. So I think that's not changing. Or at least the fact that there has been some permanent loss in demand to use office space is probably going to remain outstanding. The scale of that diminished demand, I think, is a question. What that means for the office space in the medium term, I think the most immediate question, and this is something that's been receiving a little bit more news coverage lately following the failures of Silicon Valley and Signature Bank, is upcoming debt maturities on office. So if you have a loan against an office building and you need to refinance and you have a 95% balloon payment and your cash flow is somewhat impaired, perhaps because the demand for office space has declined, that's, I think, the immediate question. That's the question we're dealing with over the next 2 years.
And there's a lot been said about office spaces and the potential to convert them into residential, into apartments. But what are some of the challenges when you're looking at converting office buildings into a bunch of apartments?
It's one of those things where it just sounds great on paper because we have a housing shortage and it seems at first glance like we might have too much office space right now. The challenge is it's just easier said than done. There are a lot of impediments, and the biggest ones are costs. A cost of refitting the buildings, of a lot of the times the cost to refit a building is compared against ground up development because taking an office floor plate that might have a lot of interior space and converting that to apartment use is costly and difficult. There are some obvious challenges. For example, you can think about requirements to need windows in apartment buildings. You might not need that in the interior of an office building where you have a farm of cubicles. You only really need 1 or 2 restrooms per floor in an office building, but in an apartment, you need 1 per each apartment unit. And that requires replumbing the entire building, potentially, digging into the concrete and laying new pipe. That is all costly. And anytime you start a big development project like that, there's always the risk of cost overruns. So I think essentially the cost is the biggest difficulty right now.
Is it happening, conversion? Where is it happening? And in some cases, it's just simpler to knock a building down and build housing.
They are happening, and they're happening at a faster rate. Conversions are happening at a faster rate than they were pre-pandemic, but they're still happening at such a small scale that in the near term is not going to meaningfully reduce the existing stock of office buildings. There's a lot going on in Boston right now, and actually a lot of these conversions are from office space to labs, which is something covered in a recent CBRE report, and they go into some detail on that. But I don't think you're going to see office conversions at a scale necessary to meaningfully reduce the existing office stock, which is sort of the problem we're talking about right now, the oversupply of office space relative to demand to lease it. That doesn't seem like it's going to change anytime soon unless buyers and investors for these sorts of projects can buy at a steep discount, or perhaps at the margins if local and state governments can potentially incentivize some of those conversions with zoning and adaptive reuse changes.
Boy, are there some major challenges ahead for this space. Anders Snyder, good to see you. Thank you. All right, we wrap up the day and take a look at what's on the docket for tomorrow here on Yahoo Finance Live. Stick around. It's closing time here at Yahoo Finance. Let's get you caught up on some of the biggest stories of the day. Shares of Alphabet ending the day nearly 3% lower on concerns about the AI threat to its search dominance. The New York Times reporting that Samsung was considering replacing Google as the default search engine on its devices with Microsoft's Bing. Bing has quickly risen in popularity thanks to its Chat GPT features. Now, Google finds itself in a race to catch up, releasing its own generative AI called Bard.
And Netflix is set to release its first quarter earnings tomorrow after the market close. Analysts are expecting the streamer to report adjusted earnings of $2.86 a share on revenue of $8.2 billion. We'll also see if we get an update on what forced the company to scrap the live airing of its Love is Blind reunion special. Netflix apologized to disappointed viewers, but did not provide much detail beyond that.
And finally, SpaceX was forced to scrub the launch of its Starship rocket, the most powerful rocket ever built. SpaceX CEO Elon Musk tweeting that a valve appeared to be frozen and the company would retry the launch in a few days. That'll do it for Yahoo Finance Live today. Be sure to come back 3 p.m. Eastern Time for all your coverage leading up to and after the closing bell. I'm Dave Briggs for Inez Ferre. Have a great night.